Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Well, gold is holding strong above $2,500 an ounce on the spot side, even as consumer confidence in the U.S. shows signs of improvement, with the recent data revealing a rise in the consumer confidence index to 103.3 in August. However, despite this optimism, global uncertainties are far from over. On the central bank front, Poland has significantly increased its gold reserves, aiming for gold to make up 20% of its total assets. Now, Ukraine's recent military incursions into Russia's Kursk region have intensified geopolitical tensions in the region, further driving demand to safe haven assets like gold, as we can see by its neighbor Poland's latest move. Now, to help us understand these implications of what this all means for gold and silver, of course, we welcome back one of our friends. We know him well here at Kitco News. We're joined by Jeffrey Christian from the CPM Group. Good to see you as always, Jeffrey. Crazy time for gold, obviously. We had you on at the beginning of June last time, and you projected that gold might be pulling back to around that 2250 mark, and then going up to 2450. I think at that time gold was trading around, 2350. But I guess my point is now with these gold prices consistently above that $2,500 mark, how do you see things playing out here?
Well, we've been saying for a couple of years that we thought that the gold price would rise into now, and that once we got into the final 4 months of 2024 and 2025, we expected the gold price to rise even more sharply. So we're looking at the recent, really, if you go back to from April through July, the gold price traded between 2,300 and 2,500. And now it's breaking above that. And our view is that, that was the platform from which the next sharp upward move would come. Now, the next sharp upward move comes because of economic distress and because of political issues, especially issues related to who's going to be running the United States after January of next year. And how do we get from here to the next presidency? I think the scope for political unrest in the United States is very high. It's also very high in many other countries. And we've already seen several countries lose their leaders in recent weeks. But you'll have a lot of dissension within Europe, which actually relates to the Polish central bank gold purchases. You have issues within Russia and other countries about who's going to run these countries going forward. And then you have international affairs. And our view has been for a couple of years that economic and political issues would grow worse 2022, 23, 24, but they would really become much more severe in the final months of 2024 and in 2025. And everything that we see, or almost everything that we see, says that scenario still is likely to play out. There are some things that are getting better politically and economically, but we think that we're headed into a very severe economic period and a very severe political period. And one of the things that we've been saying, and I think I said it to you in June, was be careful what you wish for. All these people have been wanting lower interest rates in the United States. And we have said repeatedly, the Fed will only lower interest rates when it is severe, when it is much more concerned about a potential for a recession. And that's why it's not cutting interest rates for willy-nilly purposes or just to be happy or early Christmas. It's cutting interest rates because it is extremely concerned about the potential for recessionary economic conditions emerging over the next 8 months.
Right.
And right. That's the environment in which investors say, where do I put my money? I'm going to put it in gold and silver.
Yeah. Obviously you mentioned we saw last week Jackson Hole. There was a bit of a pivot there. Now the Federal Reserve has signaled its readiness to cut rates. It's traditionally been quite bullish signal for gold, but with inflation still a concern, is the market overestimating how dovish the Fed will actually be here?
Parts of the market are clearly overestimating how dovish the Fed will be, and there's a lot of people who see the world in black and white, and it's really a matter of a spectrum there. And So you have to take it all with a grain of salt. But yeah, there's clearly many people who are hoping for a sharp decline in interest rates that is probably excessive compared to what we will see. But, I think that what you're seeing is that the Fed is saying, yeah, we have to lower interest rates a little bit now, even though we have not achieved our inflation goals.
Yeah, well, we're starting to see those cracks and the revisions come. So then could you see a scenario where the Fed disappoints the market by taking a more measured approach to rate cuts? And if so, how does that impact gold prices?
Well, okay, two things. And I'll answer that, and then I'll try to go back to your other previous question. The Fed has disappointed the market lollipop boys, the people who have been wanting lower interest rates for 2.5 years. The Fed has consistently disappointed them, and it's done it in a very systematic fashion. It's been saying, we're not going to lower interest rates now, and we're not going to lower interest rates as rapidly and as far as you think. This is what we're going to do. And then the Fed goes out and does that. And there are people in the market who refuse to listen to the Fed, refuse to believe that the Fed will do what it says it's going to do, and then they're surprised when the Fed does what it's going to do. I think there will be a lot of people who will be underwhelmed with the Fed, what, as you say, will be a measured approach. Now, just backing up a little bit, interest rates and gold. The correlation between changes in real interest rates and changes in real gold prices is actually very low, like 16%. There are a lot of people who say, higher interest rates, lower gold, lower interest rates, higher gold. That doesn't hold up to scrutiny in 84% of the months since 1968. So you've got to say, it's not that interest rates are rising or falling. Why are they rising or falling? If interest rates are falling because it looks like we're headed toward a recession, that could be good for gold because there'll be people getting out of equities and corporate bonds, and they'll be parking some of their money in gold and silver. If the interest rates are falling because the Fed feels that it can cut rates to keep us out of that kind of recession, then they have a less dynamic opposite effect on gold and silver prices. And you can find, a quarter of the time, gold and interest rates are either rising together or falling together. So the correlation is not necessarily as dynamic as a lot of people simplistically think.
Interesting. Okay, well then let's talk a little bit more about the fundamentals driving the market, because there's so much narrative, and it's just like we're talking about gold prices, but yet we're talking, of course, the Fed. We have geopolitical things happening throughout the planet. Talk to me about the fundamentals that are driving gold currently. Break that a little bit more open then here, Jeff. I mean, is it a little bit of speculative excess that could lead to a sharp correction, or is this just the new normal here? Anything surprise you?
Well, there is a little bit of speculative things, but one of the surprising things to me is the lack of speculative demand. We've seen gold prices rising really for the last 3 3/4 years now, based on longer term investment demand. So, during the last 3.5 years, you have seen until April of this year, you saw a weakening of the shorter term investment demand for gold through ETFs, and an increase in the demand for gold, for physical gold, coins and bars. So that's a longer term investor that's buying that physical stuff. And what we've seen over the last 3.5 years is long-term investors buying more gold because they're more concerned about the economic and political environment. And the shorter term opportunistic guys who say, I want to buy gold because I think the price is going to rise, or I want to go short gold because I think the price is going to fall. They've been getting out of the market until April, right?
Okay.
And so you saw ETF holdings decline for 3.5 years. In April, that turned around. And it turned around because the gold price started rising again more sharply. It broke out of a $2,300-$2,400 range, and it moved into a $2,300-$2,500 range. And there were any number of shorter-term investors, more opportunistic investors, who are saying, the gold price is rising, I want to get into it. How do I get into it quickly and effectively? The best, easiest way is to buy ETFs. So you've seen ETF demand pick up, I think, April, May, June. I think it came off in July a little bit. That is that shorter term speculative demand. But the really heartening thing for somebody who is looking for higher gold prices is that for the last 3.5 years, 3.75 years now, you have seen gold prices move higher based on longer term investor buying.
Mm-hmm. Yeah, and not just those traders out there. I mean, yeah, we had Ed Coyne on from Sprott yesterday, and he was talking about how even in the past few weeks, the inflows on the gold backside ETFs have really increased. So I guess my question is are Western investors, are the traditional investors coming back to gold finally?
Well, Western investors have been in there for the long term. With the ETFs and things like Sprott, you're seeing shorter term investors, and that's where the pushback can come that you were asking about earlier. Is those people can disappear as quickly as they appear. So if you see gold prices spike up to 2,600, and things get better economically and things get better politically, those guys can disappear. You could see a 10% reduction in the physical demand for gold on a short-term basis as those short-term investors disappear. The longer-term investors are not going to sell, probably. Some of them might. Some of them would be more likely to buy puts against and hedge their long-term physical positions against downward move. But those short-term investors who might represent 10% of the buying over the last 4 months, they couldn't leave as quickly as they appeared.
Yeah, Jeff, you were pretty accurate last time we chatted just about some of the geopolitical situations that might be coming forward that's going to be pushing people towards the safe havens. I mean, we mentioned up the top, central banks continue to be the net buyers of gold, significant purchases throughout this year, particularly countries like Poland and Turkey. They're seeing something here. I mean, what does this tell us about the global stability or the role of gold in reserves now? How has this changed fundamentally?
Yeah. Well, Poland and Turkey have fundamentally different economic reasons for buying gold. Turkey, along with Kazakhstan and Uzbekistan, have been the entrepôts for contraband, sanctions busting shipments into Russia. So there's been this tremendous need for currencies, and there's been a tremendous growth in wealth within Turkey, as well as those two stands, as people who are willing to skirt the sanctions make a lot of profits by buying stuff and transshipping it into Russia. Thus, you have seen a lot of wealth in Turkey. Turkish lira is not that great of a currency, so a lot of that tends to go into gold, and then dollars and euros. And you've seen strong demand for all three of them in Turkey. Poland's a different story, and Putin has said Poland's next after Latvia. Putin has made it very clear that he sees Poland as part of Greater Russia. And the Poles definitely know that that's the case. And the Poles are very much concerned about this, and they'd like to see his aggression stopped in Ukraine and reversed in Ukraine because they're the next country over. So they have partly been concerned about Russia, but they're also having an issue within the EU. Poland is part of the EU and the ECB, and Poland has a more conservative, if not reactionary, government now. And the EU has been pushing back on some of the regulations and legislations that the Polish government would like to impose. And the EU has been saying, no, you can't do that under EU regulations and laws. So Poland has tensions within the EU, as well as Russia on the other side of it. And it's sort of saying, okay, do we want to have that many euros? Do we want to have as many dollars as we have. They have a lot of dollars flowing into Poland because it's the transshipment location for a lot of NATO and U.S. shipments into Ukraine. So again, there's a surfeit of dollars coming into Poland, and the government has taken some of those dollars and bought gold. And significantly, they bought gold stored at the New York Fed, as far away from Russia as they can get it.
Right. Yeah. With the ongoing conflict in Ukraine and the military incursions into the Kursk region, we know that this isn't going anywhere, unfortunately. Geopolitical tensions seem high. How much of this, is tied to gold's current strength? Like, how much is this tied to it? Because you just talked about some of the things we forget. The EU, we got a lot of economic uncertainty within, that entire region right now. So where is it when we look through the noise? Are we having to unpack it all?
Oh, no. I mean, we have a list. We have a long list of issues because, when I was at Goldman Sachs, I was told we don't have problems. We have issues. Don't say, hey, we have a problem. It's an issue. We have a large list of issues facing both the world and individual countries. And it's not just the U.S. obviously is the most important country. It's the largest economy. 70% of private sector wealth, financial wealth is denominated in U.S. dollars. 60% of central bank foreign exchange reserves are in dollars. The U.S. is very critical, and it has a critical situation in terms of political and social divisions within the country. So it's very important. But, you just go north of the border to Canada, or you go to the UK or Scotland or Wales or Northern Ireland or France or Spain or Italy or Hungary or Poland, and you find political and social tensions. And it's not quite clear how it's going to resolve. And it's very funny because, the majority of people in the UK now say they wish they had never left the EU and they'd like to go back, while people in Italy and Spain and other countries in the EU are saying, hey, maybe Britain had it right and we should quit. So there's that whole European complex of political situations and social situations. And then you throw in the immigration problems there. Europe is unsettled. Russia's clearly unsettled. There are talks about the last days of a Putin regime. I don't want to speculate on that, but it's a real issue. India, you just go around the world and there are issues. There's a new government in Bangladesh. There's a new government, I believe, in Thailand. There are issues that need to be resolved politically, economically, and financially everywhere. And in each country, investors say, maybe I'm worried about the U.S. and maybe I'm worried about the world, but I'm also worried about my home situation, including the stability of the bank where I keep my money.
Yeah, well said. It's certainly an interesting time to be a journalist in the world, Jeff. Okay, we had you on last time. Obviously, we have to talk about silver too. You previously mentioned the dual role as both industrial and, of course, a monetary metal. As we sit here and talk about gold, given the current market dynamics, where do you see silver headed, especially with the fluctuations in demand and the investor fatigue that we seem to always see with this precious metal?
Yeah, we expect silver prices to rise along with gold over the next 12 to 24 months. We would not be surprised to see record intraday prices for silver. The previous record was just shy of $50 in April of 2011. And we wouldn't be surprised to see record quarterly and annual average prices for silver. So we see the price rising over the next year or two. We see that price increase predicated primarily on a return to investors buying. Some investors are continuing to buy silver, but there's been a lot of investors selling. So that if you look at net investor demand for silver, ignore what the promotional groups say about massive amounts of investment demand and massive deficits. If you actually measure the silver market accurately and honestly, the silver investors net silver investment demand is very low. was very low last year, and it continues to be very low this year. And that's why silver has lagged gold prices, and whereas you've seen gold move to new highs over the last month or so, silver's come back off from the highs that you saw in May and June. So we think that the price of silver will rise when those investors who are selling, stop selling and start buying again. And investment demand can go from 20 million ounces to 80 million ounces very quickly, and that could take the silver price from $30 to $40 very quickly on a daily or a weekly basis. Fabrication demand is important, but it's grossly overstated by promoters, and you have to understand, fabrication demand for silver is price elastic. Silver investors buy silver when the price is rising, they come pouring into the market. When the price of silver rises, fabricators look to reduce their silver consumption. So you don't see gold and silver prices pushed higher by fabrication demand, jewelry or solar panels or electronics or other things. You see the big price moves in silver due to investment demand surges.
Interesting.
And so we see strong fabrication demand in several sectors, but it's not going to push the price higher. It's going to be investment demand.
Yeah, fascinating. Because as you mentioned, we hear a lot of things about supply and demand issues. You're saying a lot of that is just short-term promo, because I always wonder, with silver playing such a critical role in the renewable energy and this green shift, particularly in solar panels, I always wondered, is the market underestimating the long-term potential despite the short-term volatility?
I don't think, I think the market overall, the market has a reasonable handle on silver use in solar panels. There are people who have excessive ideas about how much silver will be used, and it's not recoverable and refinable. There are other people who say, probably those estimates are way too high. They are. We know that the solar panel industry is very much concerned about the state of the market. There has been an overbuild in solar panel manufacturing capacity, so that capacity utilization is probably around 50% right now. And with new factories coming on stream, it may fall to about 40% over the next few years, capacity utilization in the solar panel manufacturing business. And we've seen, for example, last year there was a overbuild of solar panels. So there were quite a few more solar panels built in 2023 than were installed. So you had this inventory of solar panels, which then reduces the need for more silver to build until you draw down those inventories. So I think that the market overall has a pretty sober understanding of the role of silver in solar panels and the likelihood that it is going to continue to grow. It will probably become one of the top uses of silver over the next 10 years, but it's not going to be immediate. They understand that all of these political prognostications about solar panel building are politicians that usually don't live up to their promises. So, you kind of ignore that stuff and you look at what the solar panel industry is saying and what they're saying they can do. And then you throw in the fact that, in fact, not only can solar panels be recycled and the silver recovered, they are now. That's not a hypothetical that these solar panels can be recycled. There are solar panel recycling businesses around the world already. So that's going to be there. That reduces the need for new silver as you start recycling those things. So I think the market overall has a very sober, balanced understanding of silver use in solar panels, but there are extremes on either side.
Right. Yeah. Okay, well, you've talked about investor disillusionment in the past, particularly among those who bought into the silver hype at higher prices. I wonder, with gold at record highs, is there a similar risk of investor burnout, or what would that mean for the market here?
I don't think there's a similar risk, and for a couple of reasons. I mean, first off, gold and silver prices have risen since 2019, and they've risen as investors looked at the world and said, "Hey, I want to have more of my wealth in gold and silver and less in currencies and financial assets." So the gold price has risen to record levels based on pretty solid fundamentals of investment demand, as well as mine production, secondary recovery, and fabrication demand, and central bank demand. Those are the fundamental sectors of the gold market. And I think silver has to some extent too, but silver had this additional fillip with let's corner the silver market, let's drain the COMEX stocks. Silver's going to 100 or 750 or $1,000 an ounce. And there were a lot of people who bought into that who are now disillusioned. And they have been selling silver for at least a year and a half, and probably closer to 2 years now. And that has created sort of like an overhang in the silver market. Now, one of the questions that you can't answer definitively, because it's all, people are secretive about their gold and silver investments. How much of the disillusionment is past? Because once that stops, then the prices rise. And if you go back to 1978, 79, 80, and if you look at 2011, 2012, or rather, if you go back to 2004, 5, and 6, when you had this flip from investors being net sellers to investors being net buyers, the price of silver started rising when investors were still net sellers in both 1979 and in 2004. So it's yes, you need investors buying silver on a gross basis, but what you really need is those disillusioned investors to stop selling. That's what happened in 1979. That's what happened in 2004. And once they stop selling, the price starts moving up again, and then you have fresh buyers coming in because the price is rising.
Jeff, what's your take then? Like, how should investors position themselves to not only protect against the downside risk, but also to capitalize on these opportunities we talked about today? I mean, is it an ETF market? Are you buying the real gold product? Well, what's happening there?
Well, a lot of our investors are physical investors. I'd say, maybe. So we always suggest you be a physical investor, but be prepared to also buy puts or to buy what we call participatory options or participatory puts, where you can hang on to your physical metal when the price is high, but buy a put and protect yourself from the price falling back, and even take advantage of that price falling back. And by using a put, or by using a put paid for with a call spread, which we help our clients structure and sometimes even manage for them, what you do is you can preserve your long physical position, protect yourself from downward movements, make more money when the price does spike down on those puts, but then you buy a call spread above the market, and that gives you additional exposure to rising prices. Mm-hmm. That's one of the strategies we've been working with our clients on. Another one is butterfly straddles, where you can make money, and have some protection on the downside too. And we've had some good luck with those in there. We do have investors who are ETF investors or futures and options investors. And we do, they take our market view and they modify it for their investment strategy. They figure out how to manage their positions predicated on our views.
Yeah. So you're not buying any mining equities at these levels here, Jeff?
I have some mining equities and I'm holding them. I bought them far below current price levels, so I'm still a happy camper. But I'm not actually buying more right now.
Yeah.
I take that back. There are a couple junior opportunities that I've been studying that if I hadn't been spending all my time doing CPM Group work, I probably would have bought them by now.
But you won't tell me which, because of course we can't do that, can we? All right. Jeffrey Christian joining us, of course, from the CPM Group. Thanks as always, Jeff. I always appreciate you coming on, giving your insight. It's steady, Eddie. It's true. It's real. And we appreciate your time. Thanks again.
Yeah, I hate to be the boring old guy in slippers, but that's what I am.
Hey, it's factual. And your calls were right, too. So we'll have you on again. Thanks, Jeff. Appreciate it. Have a great day.
Thank
Jeremy
you.
Szafron. For all of us here at Kitco News, thank you for watching. We got a great week of shows coming up, so stay tuned. Hit that notification button, and we'll see you next time.